Hello viewers, so welcome to my channel. I'm Hasham. This is the last and final video on cost of capital. So far in the last three videos, I have explained you how to compute the specific cost of each source of funds, like cost of debt, cost of preference, cost of equity, cost of retained earnings. So in the previous videos, how to compute this KD, KP, KE, KR, all these things I have done in detail. And in this last video, two more problems on WACC, weighted average cost of capital. That's what I'm going to explain. So if you want the perfect knowledge on this topic, watch all the videos from beginning till end. If you have not watched the theory videos, I suggest you, first of all, watch the theory video, be clear about the concept of cost of capital, importance of cost of capital, where it is applied, why it is required, and how to compute the specific cost and how to compute the weighted average cost of capital. So before starting the 14th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. Take the screenshot of the points written on the board, then I'll explain. See the 14th problem. Calculate the weighted average cost of capital using book value weights and market value weights from the following information. Previous problem also, this type of problem we have done, where we have to compute WACC using book value weights and market value weights. The book values are given, market values are given for all the four types of funds. That is debt, preference capital, equity capital, retained earnings, and the total is also given. So retained earnings, what is the cost is not given. So we'll make the assumption. Whatever is the cost of equity, the same is the cost of retained earning. Because if the information regarding the tax liability and tax rate of shareholders, and also what is the flotation cost that will be incurred by shareholders while trading with securities, trading in securities, if that is given, then only we can calculate KR. If no tax rate is given for the shareholders and no flotation cost is given for the shareholders, we can't calculate KR. So whatever KE is there, same KE will be taken as KR. So while watching the video, always keep a calculator, pen, notebook ready. So whenever I say important point, immediately note it down. Then only you can be able to remember. Otherwise, simply watching the video, listening the lecture will not be sufficient. Now, see here, 14, calculation of WACC using book value as weights. Sources of funds given in the problem. Book value amounts are given in the problem. Same thing I have copied. No change. And specific cost. The cost of debt KD, that is given 8%. Preference 12, equity 16. Retained earning not given, but we have taken KE is equal to KR. That means 16, 16. Now multiply book value with cost, will get the total cost. 5 lakh into 8%, 40,000. 10 lakh into 12%, 1 lakh 20,000. Take the total 5 lakh 60,000. 5 lakh 60,000 is the total cost, whereas total amount, book value is 40 lakh. So on 40 lakh rupees, the company is paying 5 lakh 60,000. So what is the percentage? WACC. So 5 lakh 60,000 divided by 40 lakh into 100, 14%. That is the WACC using book value as weights. Now using market value as weights. In the problem it is asking you to calculate WACC both book value and market. Same source of funds, market values. Earlier we have taken book values, now we are taking market values. All the four market values are given in the problem. The total is 51 lakh. Specific cost same, no change. 8%, 12, 16, 16. Now multiply 5 lakh into 8%, 40,000. 11 lakh into 12%, 132. 25 lakh into 16%, 4 lakh. Take the total 7 lakh 32,000. That is the cost on the total capital of 51 lakh. So WSCC is equal to 7,32,000 divided by 51 lakh into 100. 14.35%. That is the WSCC using market value as weight. That's it. This is the end of problem number 14. Last and final problem. The electricity manufacturing company wishes to determine the WACC for evaluating capital budgeting projects. You have been supplied the following information to calculate the value of KO. KO stands for combined cost or overall cost. It is nothing but weighted average cost. So the symbol used is KO for WACC. Balance sheet is given sundry assets 39 lakh, we don't require. Current liability, we don't need. Debentures 9 lakh, preference share 4 lakh 50,000, equity share 12 lakh and retained earnings 4 lakh 50,000. The 4 long-term funds are there that we need. Now, anticipating external financing information, except retained earnings, all other are external financing information. So we are given 20 years 8% debentures. That means debentures are redeemable after 20 years. Of rupees 2,500 face value. Each debenture face value is 2,500. But how much debentures are there? 9 lakh. In the balance sheet it is given total 9 lakh rupees debentures. Each debenture face value 2,500. Redeemable at 5% premium. That means after 20 years, the company will redeem the debentures at 5% premium. Sold at par. That means while issuing the debentures, it was issued at par value. 2,500 rupees debenture, 2,500 only it was issued. No premium, no discount. And 2% flotation cost. So while calculating NP, net proceeds on issue, deduct 2% flotation cost. By using this information, we can be able to calculate KD, cost of preference capital, redeemable debentures. In this problem, we have to calculate specific cost and also we have to calculate WSCC, combine both. So first of all, calculation of specific cost of capital, cost of debt, KD, redeemable debentures. Already in the previous video, I have explained you the formula for calculating KD for redeemable. I plus RV minus NP by N divided by RV plus NP divided by 2 into 1 minus T into 100. I stands for interest. The rate of interest, debentures will carry 8% interest. Total debentures are 9 lakh given in the balance sheet. So 9 lakh into 8%, 72,000, we got I. RV, redemption value. It is given that redeemable at 5% premium. The company has agreed that at the time of redemption, 5% premium will be given. The face value is 9 lakh plus 5%. 5% of 9 lakh is 45,000. So 9 lakh 45,000 is the RV, redemption value. NP, net proceeds on issue. At the time of issue, it was sold at par. Par value means face value, 9 lakh. But 2% flotation cost is given. So we have to subtract flotation cost. So 9 lakh minus 2%. 2% comes to 18,000. Deduct 8 lakh 82,000. 2% of this one becomes how much? 1% 9,000, 2% 18,000. 2% will be 18,000. So 9 lakh minus 18,000, you will get 8 lakh 82,000 net proceeds. N stands for number of years of redemption, 20 years. And T stands for tax rate. That is given, the corporate tax rate is 55%, 0.55. Right? Now KD is equal to, now we substitute all the values in the formula I. In place of I, 72,000. RV, 9 lakh 45,000. And NP, 8 lakh 82,000. N is equal to 20. Divided by 945,000 plus 882,000 divided by 2. Now first of all, 945 minus 882,000 divided by 20. Use the calculator and find out. 9,45,000 minus 882,000 divided by 20. You will get 3,150. Similarly, denominator 945,000 plus 882,000 divided by 2. You will get 913,500. So 72,000 plus 3,150, 75,150. 1 minus 0.55. 0.55 is the tax rate, 55%. So 0.45 into 100. So 75, 150 by 913, 500 into 0.45 into 100. You will get 3.70. That is the cost of debt, KD, after tax. That's it. Now, secondly, preference. 10% preference share, sale price 100 rupees per share, but flotation cost is 2%. How much is the preference share capital? It is given 4,50,000. So the formula, it is irredeemable. If it is redeemable, then we have to apply this type of formula. But if it is irredeemable, then KP is equal to DP by NP into 100. Simple formula for irredeemable preference shares. Period of redemption is not given. So DP, preference dividend. What is the rate of preference dividend? 10%. Amount is 4,50,000. So 4,50,000 into 10%, 45,000. Net proceeds on issue. The face value is 4,50,000 minus 2% flotation cost is given. Subtract flotation cost. 2% of 4,50,000, 9,000, deduct 4,41,000. Net proceeds. So KP is equal to 45,000. This is the DP. NP 4,41,000 into 100. 10.20%. That is the KP, cost of preference. So we have calculated KD, cost of debt, KP, cost of preference. The next thing is equity, KE. Equity shares, sale price 115 per share. This is the market price. Flotation cost would be 5 rupees. Actually, flotation cost will be deducted from the market price. The market price is 115. So 115 minus 5 is 110. That is the market price per share. The corporate tax rate 55% and its shareholders tax bracket is 30%. And the expected equity dividend growth is 5%. And the expected dividend at the end of the financial year is 11 rupees per share. So already D1 is given. It is not the past dividend, it is the expected dividend. So it is D1. If the past dividend is given, then we have to take a DO, just like the previous problem. But here expected dividend is given, D1. So we have to apply DP plus G approach, dividend price plus growth approach to calculate the KE. Now cost of equity, K is equal to D1 by P into 100 plus D. Same formula what we have done. D1, expected dividend at the end of the financial year, that is given 11 rupees. Market price, the market price is 115. But from market price, we have to subtract the flotation cost. The flotation cost is 5 rupees. So 115 minus 5, 110. So 110 is the market price into 100. Plus growth rate is 5%. So 11 by 110 into 100 is 10 plus 5, 15. We got KE. We have calculated KD, KP and KE. Lastly, we have to calculate retained earning, KR. Cost of retained earning. So KR formula, KE into 1 minus T into 1 minus B. This T stands for the tax rate on the shareholders' investments. The tax rate on shareholders' investment, that is given as 30%. So T is equal to 0.3. B is the brokerage payable by the shareholder in transferring the securities. But flotation cost is not given for the shareholder. The company flotation cost is different. But here B stands for the flotation cost that will be incurred by shareholder while trading with securities. That is not given. So B is equal to 0. So KE is 15%. Tax rate 0.3, 30%. 1 minus B. B is 0. 1 minus 0. So 15 into 1 minus 0.3 is 0.7 into 1. It comes to 10.5%. That is KR. So this is the first problem where we have to calculate both the specific cost and also WACC, weighted average cost of capital. Now as usual, it's very simple to calculate WACC. Once we get this specific cost, the source of fund, debentures, preference shares, equity shares, retained earning. Amounts are given in the problem: 9 lakh, 4 lakh 50,000, 12 lakh, 4 lakh 50,000. That is given in the balance sheet. Take the total, 30 lakh is the total fund. And specific cost, just now we have calculated KD 3.7%, KP 10.2%, and KE 15%, and KR 10.5%. It is not given in the problem, we have calculated. Now multiply the amount with specific cost. 9 lakh into 3.7%, 33,300. 4 lakh 50,000 into 10.2%, 45,900. 12 lakh into 15%, 180,000. 4 lakh 50,000 into 10.5%, 47,250. Take the total of the cost, 3 lakh 6,450. 306,450 on the total fund of 30 lakh. So WACC is equal to total cost divided by total amount into 100. So total cost is 3,06,450. Total amount is 30 lakh into 100, 10.22%. So this 10.22% is the weighted average cost of capital. That's all. So we have done totally 15 problems on cost of capital. Hope you understood the complete technique of how to compute the cost of capital. See here, your objective should not be just to qualify the examination and get good marks in the results. That is a very narrow objective. Your broad objective should be to acquire the knowledge, to understand, because these are the things you have to do in future in your businesses, in your companies. So these are very much practical. Don't take it just theoretical to pass the examination. I am explaining each and every point in detail so that you will get confidence in the subject. So if you are satisfied, give a like to the video, share my channel among your friends. Subscribe my channel if you have not yet subscribed. And comment and write from where you are watching this video, from which city, which country you are watching the video. That gives me more motivation to provide more and more knowledgeable videos for your subjects. So inshallah we'll take up the next topic in the next video.